This is Ralph Sass, and this is Accounting 211, Chapter 7 lecture. And once again, it'll probably be in two parts. So let me go ahead and... what we're doing for the rest of the semester is we're going to be going through the balance sheet and taking a look at how those numbers are reflected in the balance sheet. Chapters 1 through 5, we went through the accounting cycle. In Chapter 6, we took a look at how things work in retail and wholesale organizations. So what we're going to do now through the rest of the semester is take a look at how various items are handled on the balance sheet. And basically to do this, we're going to walk through the balance sheet. So we're going to start off with the assets and cash and marketable securities and some of those things that can be turned quickly into cash. And the question always is, how much cash should a business have? And the answer is enough, but not too much. You need enough to pay your bills, but if you have too much cash, cash does not earn any rate of return to speak of. So what that means is if you have a lot of cash, you've got a lot of money tied up in assets that aren't earning a great rate of return. So you really want your assets to be invested in inventory or products or whatever it is you're doing and not sitting around. Okay, and what that may mean is that you're going to take some of your cash and invest it in some short-term investments. So when we take a look at your financial assets, those assets that are short-term in nature, they boil down into about three categories. The first of which is cash, and it sounds really easy, but we're going to talk here in a couple of minutes of what is cash. The next one is short-term investments, things like treasury bills, treasury notes, maybe a CD, something where you're trying to earn a little bit of return on your cash while you're waiting for, whatever opportunity, what have you, to arise. And then finally, we're going to talk about how we handle receivables, and what their net realizable value is. If you look at what's going on in a business, you're going to see some sort of a flow chart that looks like this. We're expecting our customers to pay you, so we have some accounts receivable. And then what we may do is take some of that excess cash and invest it temporarily into some sort of marketable security so we earn at least some interest on it, some rate of return on it. And then when we need the money to pay employees, pay suppliers, put the new piece of equipment into our building, whatever, we sell those, okay, and then go ahead and use cash and cash equivalents to make those cash payments that are due. So that is basically what is going on with cash, okay. Cash is going to be, and cash equivalents are going to show up on our balance sheet at their face value, okay. So whatever it says is, when we look at the checking account, it says we have $10,254. What shows up? $10,254. Short-term securities, marketable securities, whatever, are going to show up at their fair market value. So in that particular case, suppose I bought, and why you would buy, let's suppose you bought a bond and you bought it for 10 grand. And now, because interest rates have gone up, the value of the bond has gone down. It's now only worth $9,800. What would you show that on your balance sheet as? $9,800, even though you paid 10 grand for it. There are a couple of exceptions, but for the most part, we're not going to worry about those exceptions this semester. And finally, accounts receivable. Accounts receivable are going to show up on our balance sheet at their net realizable value, which is what we expect them to be worth, okay? For example, if I sell $10,000 worth of goods to a well-respected, high credit company, I expect to get paid that 10 grand back. If, on the other hand, I sold that $10,000 of merchandise to some fly-by-night company whose address is his car, what have you, I may expect never to get paid back, and maybe the net realizable value of that accounts receivable is zero. And so we need to make sure that our balance sheet reflects what we really think those accounts receivable are worth, and we're going to find out how to do that in the second video to this chapter. Notice cash. Cash includes a lot of things. Cash is defined as any deposit that banks will take. We all think of coins and paper money as cash, but some checks and those checks we have sitting in our office desk drawer that we haven't deposited yet are going to get included as cash. Okay? Traveler's checks, money orders, and bank credit card sales are also going to be included as cash. A couple of quick notes about a couple of these. Bank credit card sales, typically you get paid for those the day after the sale. So when I go into Walmart and charge $100 today, Walmart basically gets $97 tomorrow. Where does that other $3 go? That other $3 goes to Visa as part of their service fee and service charge, but Walmart will get the vast majority of that money tomorrow. The other one I want to talk about is traveler's checks. Traveler's checks used to be really popular. They're not so much anymore. Credit cards have really taken their place. The big ones for traveler's checks used to be American Express, and what you would do is, since nobody knew you, they didn't know if they could accept your check, personal check. Well, when you went on vacation, you didn't want to carry cash. You didn't know if people in Florida would take your check. So what was created at the time were traveler's checks, and you'd typically go to a bank or what have you and buy these, and then you could go on vacation, and everybody knew, and the big one was American Express at the time. Everyone would take American Express traveler's checks as if they were cash, and the ad on TV used to say, you know, in the event they're lost or stolen, they would be replaced immediately. So they would be just like, you know, a credit card today. And for the most part, credit cards have replaced them. There are some other items that do get reported on the balance sheets that we need to be aware of. Cash equivalents are things that can be turned quickly into cash. Okay. They're liquid short-term investments. They have, relatively speaking, a stable market value. Usually they mature within 90 days. Usually these are U.S. Treasury bills. Okay. So if you go out and buy a U.S. Treasury bill, to invest some of your short-term cash until it's needed for, you know, salaries or buying that new piece of equipment or whatever, that's going to be included as cash on your balance sheet. Restricted cash is not reported on your balance sheet, and the reason why it's not reported, or I should say, it's reported on the balance sheet, it's just not listed as a current asset, even though it's cash. And the reason is it's listed as an investment because it's not available for paying the bills. What happened is a bank, in order to make you a loan, let's suppose you wanted 10 grand. And the bank said, fine, I'll lend you 10 grand, but you have to keep a minimum of $1,000 on hand in your checking account. That $1,000 is restricted cash because you can't spend it on everything because you have to leave it on deposit at the bank. The reason why the bank would do that is because it had the impact of raising their effective interest rate. They lent you 10 grand, but you could only use 9 grand of it. And so in essence, what they just did is they're charging you interest on 10 grand, but you can only use 9 grand. So they've increased the interest rate. Lots of companies, when they borrow money, do have what they call restricted cash. But since it's not available, it's counted as an asset, as an investment on your balance sheet. Okay. Keep in mind, and we talked about this early on, you want to make sure that you don't leave a large amount of cash idle because it doesn't earn a return. But you also need enough on hand to pay your bills, so you're always kind of fighting this battle between having enough to pay the bills, but not so much that it's dragging down your rate of return. So there's always that battle. You also have to be very careful on accounting for cash. Most places you want to deposit your cash every day, if for no other reason to prevent theft and fraud. You don't want you know, some of that cash to disappear. So it's really important to manage cash appropriately. Some internal cash things you can do, and big companies do this really well. One is they segregate authorization, custody, and recording of cash. Go back to chapter 1. Remember how we had the treasurer and the controller? One person held the cash, the other one had the records. Why do we do that? To control, you know, to provide an internal control over cash. Some other things we do, okay, is we have a cash budget. We talk about that in Accounting 212. We're not going to talk about budgets this semester, requiring daily deposits. So there's less of an opportunity for cash to be lost, stolen, what have you. Making all payments by check, not just reaching into the cash register and saying, hey, we owe him $200. Let's just reach into the cash register, grab the $200 and hand it to him and be done. Okay. It leads to a very weak control over cash. Okay. Requiring that expenditures be verified with some sort of a bill or an invoice, what have you, and properly reconciling your bank statements are always to improve your control over cash. What happens, unfortunately, perhaps more often than we'd like to think, at the end of the day, that cash register is going to be either too high or too low. So what we have is we have a cash over, cash short account, okay? And depending upon whether we're over or short, depends upon whether it's debited or credited. In this particular case, we were short by $15. So notice what we do is we credit cash because we have $15 less cash than we should, and we debit, in this case, cash over and cash short. Tomorrow, if we're over by 20 bucks, just reverse that transaction. It's cash is the debit, cash over and short is the credit. God willing, at the end of the day or at the end of the month, those cash overages and cash shortages balance each other out and the value is zero. Ultimately, you may have to include it in your income statement or what have you as additional revenue or expenses, what have you. If you're short cash a lot, it's probably because somebody is stealing some cash. You do want to reconcile your bank statement on a regular basis. And part of the reason is so you have the information necessary for doing your journal transactions. Okay. To reconcile your bank account, I always start with what they have there on the left, with looking at the balance on that checking statement. And then add deposits in transit. Those are deposits that we've already provided to the bank, but for whatever reason did not show up on the statement, probably because they were submitted after the cutoff date for the statements. Then we subtract outstanding checks. Those are checks that we wrote that are out there floating around that have not been cashed yet, haven't cleared. And then we add or subtract any bank adjustments. These are things that the bank may have collected funds on our behalf or paid funds on our behalf that we forgot to enter in our that we forgot to enter, and so that'll give us then our adjusted balance. Okay. Now going over to the right hand side there, taking a look at your checking account, add deposits by the bank. Sometimes people will pay the bank, and you'll have arrangements for them to pay the bank directly, and you will have not written them into your checking account, what have you. Automatic deposits are the one that come to mind for you and I, that sometimes we forget about those automatic deposits. Then we have to subtract any service charges or checks for insufficient funds, any book errors, any types of addition, subtraction errors are going to give us our adjusted balance. One quick note, anything that we do over there on the yellow side to the balance per the depositor, we're going to need to make journal entries for. So anything on the gray side, we do not need to make journal entries for. Anything on the yellow side, we're going to need to make appropriate journal entries. Here's an example of reconciling a bank statement. There is going to be a homework problem on it, what have you. I'm going to let you work through that on your own. Hopefully most of you have done that before. Notice the balance per the bank statement was $5,000. They added deposits in transit of $410, subtracted the outstanding checks, and came up with the adjusted bank balance of $4,693.32. 99.9% of the time, that's all you need to do. Okay, for the bank side. For your side, notice what they did. They took your balance per the depositor's records of $4,262.83, added the note collected and the interest earned. We're going to have to make journal entries for those. Then we're going to also have to deduct the collection fee, the NSF check, the service charge, and the error we made. And God willing, that adjusted cash balance, $4,693.32, will be the same balance for the bank statement. Now we need to go ahead and make some journal entries. Okay. And notice the journal entries here, and let's go back. The 524.74, right there where for add those items. Notice cash goes up by 524.74, and we have the note receivable and interest revenue are my credits. Then notice also at the very bottom the collection fee, the NSF check, the service charge, and the error. Okay. Notice what they did there. The bank service charge, they grouped those two together at 17. Notice the accounts receivable, Jay Ball. He wrote us a check. The check was bad. The check didn't clear. The check bounced. I have to recreate that accounts receivable for Mr. Ball and then proceed to try to collect from him. And then the error was $27 for the telephone expense. So that becomes my debit, and my credit is the cash for $94.24. So those are my debits and credits. Most companies also have a petty cash fund. This is a cash fund. I usually say we used to keep it in like a cigar box, usually kept in an envelope or something, usually with a main admin assistant or what have you. It's used for minor expenses. You know, somebody comes from the post office and there's some postage due. Good Lord, you don't want to get out a checkbook and have to write them a check for 23 cents. You want to be able to reach into your envelope, hand him 23 cents, and send him or her on their way. It usually has one custodian, admin assistant, whatever. It does get replenished from time to time, i.e. you fill it back up with $100 or whatever you keep in there. In order to create the accounts, the very first journal entry you'll make will be a debit to petty cash and a credit to cash. That'll take money out of your cash account and create the petty cash. And maybe for $100 or $200, which would be probably the most it would ever be. And then from time to time, you'll have to replenish it. And what you'll do is you'll have debits for a number of expenses, postage, pizza, whatever it might be, and then your credit for cash to get the money back out of cash to replenish it. So those are the two journal entries that you would typically make in these situations. Short-term investments include things like bond investments, what have you. They're counted as current assets. They're almost as liquid as cash, but usually have to sell them to turn them into cash. They're usually readily marketable, meaning they're easy to sell. Usually they're not capital stock investments. Usually the ones you would make would be in treasury bills, treasury notes, or treasury bonds because they're so stable. Okay. When you would purchase them and why you would purchase a stock, I don't know for a company, but let's go ahead and go with their example. They bought marketable securities for $196,000 and paid cash of $196,000. Note it included the $4,000 in the 4,000 shares at the $48.98 plus the 80 cents commission. Okay. And notice they figured out the cost per share was 49 bucks. When that company paid dividend, notice cash went up, by this case $1,200, and I have a credit for dividend revenue. It's a revenue account for $1,200, and that's the journal entry to record that. In this particular case, I sold it, okay, for $50.04, whoops, less a $20 brokerage commission. So notice my cash went up by 25 grand. Notice how that's calculated. I sold 500 shares at $50.04 minus that $20 commission for a total of 25 grand. Okay. My cost basis was $49. Remember, I figured that out on the last slide. Okay, so I have 500 times 49. My cost is 24.5. So my gain on sale is $500. Notice it's a credit. What does it do? It works to increase owner's equity. And yes, we'll have to pay tax on that. And finally, if I had a loss, if I sold it for $48.01, notice I sold 2,500 shares at $48.01 minus $25 in brokerage fees means I collected $120,000 in cash. However, I have to get it off of my balance sheet, those marketable securities at $122.5. Well, how did I get that? 2,500 times 49. The difference between those two is $2,500. That's on a loss on a sale of investment. And yes, For that would probably be deductible for tax purposes, which is why it's a debit, because what does that do? It reduces owner's equity. That concludes the lecture for the first part of Chapter 7.